Trump is crashing the stock market by 20% this month, but he's doing it on purpose.
Last week, Warren Buffett sold $134 billion worth of stock. At the same time, economic uncertainty hit its highest level since the COVID-19 pandemic. Coincidence? I'm not so sure anymore. Like the dark clouds gathering before a financial storm, these events signal something is brewing in our markets. My analysis of economic data, administration statements, and Federal Reserve policies reveals concerning connections between these developments. And they also raise a critical question. Is Trump intentionally destabilizing the market to achieve a larger economic goal? The evidence I've uncovered might surprise you, and what also might surprise you is how much of your data is bought and sold by online data brokers, but more on that later. The bottom line is understanding these market dynamics could help protect your portfolio from what appears to be approaching on the horizon. Let's start with something crazy. Since February, the stock market has lost $5 trillion in value. That's not a typo. That's trillion with a T. We are talking about an amount of money so large it's honestly hard to even comprehend. And to put that in perspective, that's equivalent to the combined GDP of countries like Russia and Australia. But I'm getting sidetracked. What makes this market plunge so interesting is the market timing. You see, this massive drop happened right after Trump started ramping up his economic policy announcements, particularly around tariffs. The correlation is remarkably precise. Now, I'm not one for conspiracy theories. Okay, maybe I am. But even I have to admit that is some pretty suspicious timing. And here's where things get even weirder. When most presidents see the market tank like this, they absolutely freak out. They call emergency meetings, they make measuring statements to calm investors, they basically do everything short of personally standing on Wall Street with a please don't sell sign. But Trump's administration, they seemed pretty chill about the whole thing, almost like they expected it. And the pattern becomes impossible to ignore when tracking Trump's announcements against market reactions. He mentions new tariffs and boom, the market takes a hit. You don't need to be a financial genius to spot the relationship. It's right there in black and red, mostly red lately, if you know what I mean. And the Economic Policy Uncertainty Index, which measures economic anxiety, just hit its highest levels since the COVID pandemic, which is extremely unusual during what's supposed to be a strong economy. Typically, this index stays low when things are going well financially, and its current spike suggests something unusual is happening. March 10th provided one of the clearest examples when the tech-heavy NASDAQ experienced its worst single-day performance since September 2022, a brutal 4% drop in just hours. A tech executive mentioned that he watched his company's value plummet by 9% that day, wiping out months of gains and forcing him to postpone a planned expansion. And what happened right before the crash? Specific policy announcements from the Trump administration. The technology sector has been driving the market growth for years, so the sudden nosedive isn't something we can dismiss as coincidence. And the benchmark S&P 500 has shed trillions amid what Al Jazeera described as Trump's dizzying back and forth announcements on tariffs, alongside growing recession fears which have been mounting in recent months. Financial experts have pointed out that these vacillating economic policies have created uncertainty, something investors famously don't like. Yet despite knowing this, the announcements continue. Now, most presidents build their entire reputation around keeping the markets happy. Their popularity rises and falls with the Dow Jones. So why would Trump risk tanking the very markets that he constantly brags about? It honestly doesn't make sense, unless something else is going on. What if I told you there's actually a logical reason why Trump might want a temporary market crash? I know that sounds crazy at first, like why would anyone, especially Trump, deliberately crash something that they take credit for building up? It's like a chef burning down their own restaurant. But bear with me because there's a method to this madness.
Everyone is finding this a bit much. If you look at just the measure of uncertainty, this is just a particular measure, it's showing just how much people are talking about a particular issue. In this case, trade.
You see, the unpredictable nature of these policies has created an environment where investors struggle to assess risks and make informed decisions, and this has naturally led to a more cautious approach, contributing significantly to the volatility we're seeing. And volatility, my friends, can sometimes be useful, especially if you know it's coming and can prepare accordingly. And what can also be useful is subscribing to the channel if you haven't done so already, because it's a free way you can show support if you find this content enjoyable, and it is much appreciated. Now, the volatility we just talked about, it might be part of a $7 trillion chess game happening right under our noses. And while everyone's fixated on daily market swings, there's a financial time bomb ticking in the background that almost nobody is talking about. The US government needs to refinance $7 trillion in debt within the next 6 months. That's not a typo. $7 trillion with a T dollars. This is potentially the biggest financial challenge facing our economy right now. Think about it like managing your household household budget when interest rates suddenly spike. You know those adjustable rate loans become much more expensive. Now, scale that up to the national level. Even a small percentage change translates to billions in additional costs with amounts that are this large. It's like trying to refinance your home mortgage during the worst possible market conditions, except the stakes affect every single American taxpayer. Now, according to financial experts like Anthony Pompliano, the Trump administration has a very specific goal. They don't want to refinance this mountain of debt at interest rates above 4%. The problem? The 10-year Treasury yield, which serves as a benchmark for these rates, recently climbed as high as 4.8%. That's well above their comfort zone, creating a serious predicament for the administration's refinance strategy. Last year alone, interest payments on our national debt exceeded $1 trillion. That's money that could have been spent building infrastructure, improving healthcare, or funding tax cuts. Instead, it just went to servicing existing debt, similar to paying the minimum payment on your credit card while you watch the balance grow. Now, here's where things get interesting. When markets become unstable, investors typically flee to safer assets, primarily U.S. Treasury bonds. These bonds function like financial shelter during economic storms, a safety net that investors instinctively run to during turbulence. When more investors buy these bonds, their prices increase, and their yields, essentially the interest rates, decrease. Basically, supply and demand economics. Lower bond yields directly translate to lower interest rates when the government refinances its debt. And the government needs to secure these new rates within a specific window, and current rates are simply too high. Now, our national debt to GDP ratio is approaching levels that we have not seen since World War II, creating real constraints on government financial capabilities. Consider this possibility. What if someone deliberately created market uncertainty to drive investors towards treasury bonds, pushing yields down just before this massive refinancing? Pompliano points out, the administration appears focused on influencing market conditions to lower these rates, potentially through the actions that create the uncertainty we've been witnessing. It would be like causing a small storm now to avoid a hurricane later. A temporary market downturn that lowers interest rates could save hundreds of billions when refinancing that $7 trillion debt load, benefiting the country for years to come. Now, the financial mechanics are straightforward. Increased demand for bonds pushes yields down. So by creating conditions that encourage more bond purchases like market uncertainty, the administration could effectively lower the cost of its upcoming debt refinancing. Is this actually happening? The evidence is compelling. The timing of market-moving announcements, the unusual calm from administration officials during significant market drops, and the practical financial benefits all align with this theory, but this raises more questions. If lower interest rates would benefit the government's refinancing efforts, who else would benefit? And is this a deliberate strategy, or are we connecting unrelated dots? You see, the implications are enormous for investors, homeowners, and everyone with a stake in the American economy, which is basically all of us, especially when it comes to how much of your personal data is online, which brings me to the sponsor of today's video, Delete Me. Now, this is a service that I personally use, and they have removed my personal information from dozens of sites. Data breaches are becoming more common than ever, and that is why the sponsor of today's video, Delete Me, is more important than ever. It helps you easily remove your personal information, like your name, address, phone number, email, and more from data broker websites that buy, sell, and trade your data. The process is simple. Simply submit your information, and within 7 days, you receive a report showing exactly where your data was found and removed. Delete Me continues to monitor and remove your data all year long, and I can tell you from personal experience that it actually works. Now, you can get 20% off all US plans today by heading to the link in the description below to get started and join the thousands of people who trust Delete Me to protect their online privacy and take control of your data today. Now, speaking of benefiting from lower interest rates, there's a financial pressure cooker building at the Federal Reserve right now that almost nobody is talking about. The Fed has resisted cutting rates for months despite Trump's very public demands, but what if all this market chaos is actually designed to force their hand in a way they can't ignore? You see, here's the thing about the Federal Reserve. They're technically independent from the White House and Congress. The president can't just call up the Fed chair and say, hey, I need you to slash rates this Thursday. That's not how it works. But there's a fascinating loophole in this arrangement that Trump might be exploiting right now. The Fed must maintain stable prices and maximize employment. When the economy shows trouble, like a $5 trillion market plunge type of trouble, they typically respond by cutting interest rates to stabilize markets. And while a president can't directly order rate cuts, they could theoretically create conditions that make those cuts almost inevitable. And if you look at prediction markets right now, they're showing a greater than 75% chance of 2 or more interest rate cuts this year. That's substantially higher than what analysts expected just a few months ago. Something shifted in the financial landscape, and the timing aligns perfectly with the market turbulence that we've been discussing. The Fed follows a very predictable pattern. When markets tumble and economic instability rises, they step in with rate cuts to save the day. Think of it like your home's thermostat. When the economic temperature gets too cold, the Fed turns up the heat by lowering rates, warming up activity throughout the system. Have you ever wondered how these abstract Fed decisions might actually affect your daily life? These potential rate cuts would benefit regular Americans in tangible ways. When the Fed lowers rates, it creates a domino effect throughout the entire economy. What might change for you? Mortgage rates drop, making home buying more affordable. Auto loans get cheaper. Credit card interest rates decrease. Student loans become less burdensome as well. And as Anthony Pompliano points out, as interest rates decline, more buyers will emerge, but so will many sellers. We need the housing market to thaw. He's highlighting how rate cuts could finally break the gridlock in housing where both buyers and sellers have been sitting on the sidelines due to high rates. A more balanced housing market benefits everyone. Sellers can move on with their lives and buyers can finally afford homes again. And this creates a scenario where short-term market pain could lead to long-term economic benefits for average American citizens. Lower rates means more money in people's pockets, more affordable big purchases, and generally more economic activity. You see, if the Federal Reserve cuts rates, who gets the credit politically? Not the Fed. They're just responding to the economic conditions. The credit would likely go to the administration that fixed the economic turbulence. So even if Trump were deliberately creating market uncertainty to force rate cuts, he could still position himself as the economic savior once those cuts come through and markets recover. The increasing market volatility we're witnessing creates perfect conditions for the Fed to cut interest rates. They almost have no choice at this point, and when those cuts come, which prediction markets suggest is highly likely, they'll benefit both from the government's massive debt refinancing needs and everyday Americans' borrowing costs. It's ultimately a win-win situation that emerges from what initially looked like market chaos. And while everyone has been focused on interest rates and political maneuvers, the world's most famous investor has been quietly sending us a $134 billion warning signal, an absolutely massive amount of stocks from Berkshire Hathaway's portfolio. And when the Oracle of Omaha makes a move that dramatic, it's like watching the smartest guy in the casino suddenly cash out all his chips and head for the exit. Buffett has built his legendary career on a simple principle: be fearful when others are greedy and greedy when others are fearful. His recent actions speak volumes. Right now, he's definitely in the fearful camp, but the big question is, what exactly is he afraid of? Is Buffett seeing the same potential manipulation we've been discussing, or is there something else driving his decision? This is where things get really interesting. There's actually a completely different explanation for what's happening in the markets, one that has nothing to do with political manipulation or forcing the Fed's hand. Many market analysts believe we've simply been witnessing a natural correction that was long overdue. And Senator Tim Sheehy recently made headlines by claiming the stock market had been on a sugar high for an extended period anyways. The implication? This downturn might actually be healthy in the long run, a necessary reset after years of unsustainable growth. And when you think about it, this perspective makes sense when you consider the market's behavior before the drop and the fact that a correction on average occurs every 12 months. And what's particularly telling is Sheehy's observation that the market's impressive gains hadn't necessarily been benefiting smaller companies and average shareholders. This points to a fundamental imbalance that many analysts have been warning about for years. The market had become dangerously top-heavy, with a handful of megatech companies driving most of the gains, while the broader economy basically lagged behind. This concentration basically created a situation where impressive-looking index numbers masked a much more complicated reality. The S&P 500 looked great, but if you dig deeper, there were thousands of smaller companies that were struggling to keep up. It's like one NBA player standing among average height people, skewing the room's average height. The divide between market performance and economic reality had grown so wide that something had to give. And in this view, what we're witnessing is simply market physics at work. Gravity eventually pulls everything back down to earth. Now, looking at Buffett's track record, he's consistently spotted market excesses before they correct. He sidestepped the dot-com bubble and reduced exposure before the 2008 financial crisis, preserving billions for his investors. His current moves suggest he sees similar warning signs today. But Buffett also has unparalleled access to information and insights, and he regularly speaks with business leaders, policymakers, and financial insiders. If unusual forces are at work, whether political or manipulation or something else entirely, he'd likely spot the pattern early. So So which explanation holds more water? The manipulation theory accounts for the timing and severity of the drop, particularly around political events. The natural correction theory explains the market's fundamental imbalances and unsustainable valuations that were bound to reset anyways. So the truth might actually lie somewhere in between. Markets are complex systems influenced by countless variables, and no single explanation tells the whole story. What matters more is understanding what this means for your investments, and whether it's manipulation or correction, we could be entering a period of significant volatility followed by lower interest rates. As these balances unwind, we'll likely see more even distribution of performance across market sectors, creating opportunities for investors that are willing to look beyond the usual suspects. If you had Buffett's insights and foresight, would you be holding tight to your stocks or building your cash reserves to capitalize on the coming opportunities? All right, so what's the takeaway from all of this? Whether Trump has master plans or we're witnessing natural market forces, interest rates could drop, benefiting government refinancing and also your personal finances. The real question is, what should you do? Smart money prepares for whatever comes next, and Warren Buffett's wisdom hits home. Be fearful when others are greedy, and greedy when others are fearful. While everyone panics about market volatility, you now have context most investors lack. Use this knowledge to protect assets and position yourself for opportunities when rates fall. What's your strategy for the coming rate changes? Let me know what you think in the comment section below, and we'll catch you on the next episode.